So if the Fed really wants bonds to go down, it's going to have to buy the bonds itself. But of course, first it has to stop selling bonds, because that's what it's doing now. It's selling bonds, and a lot of other people are selling long-term bonds. You'd have to have your head examined to want to buy a long-term U.S. Treasury, even at 4.2%. Inflation is going to be well in excess of that. That's what the gold market is saying loud and clear, except nobody is paying attention, at least, in the mainstream, because inflation is going to be much higher. And that's why the gold price is rising the way it is. And that's why bonds are falling, because inflation is bearish for bonds and bullish for gold.
Gold and silver sank from another record and new 12-year high, respectively, on Wednesday afternoon in London. They fell together with Western stock markets and erased this week's prior jump, as the U.S. dollar extended its gains on the currency market, and longer-term U.S. interest rates rose again in the bond market despite weaker data from the world's largest economy. While lower rates are still bullish for gold, which doesn't pay interest or dividends, higher rates don't necessarily put pressure on bullion anymore, Bank of America said, maintaining a gold price target of $3,000 per ounce. Global financial advisor Peter Schiff highlights the unfavorable bond market conditions, where inflation is set to outpace yields. He notes that rising gold prices indicate a growing awareness of these economic challenges. As a result, he expects gold and silver prices to climb, potentially leading gold stock indexes to exceed early 2020 highs. Analysts at Bank of America asked that question in a note on Wednesday, explaining that the outlook for U.S. debt is bullish for the precious metal. With debt as a share of GDP set to break record highs in the coming years, the Treasury Department has to sell more bonds to investors, who may demand higher yields. When yields rise, the price of bonds on the secondary market falls. In his analysis, Peter Schiff challenges the common belief that higher rates hurt gold, highlighting that gold prices are climbing alongside these long-term rates. According to the CME Derivatives Exchange's FedWatch tool, market forecasts for where the U.S. Federal Reserve will cut its key overnight interest rate by the end of the year held at 4.45% per annum, higher by 0.2 of a percentage point from last month. However, as inflation has fallen in the past year, gold has ascended to record highs, rising 40% in the previous 12 months. According to Peter Schiff, inflation is not under control, and increasing fiscal deficits will lead to more treasury supply on the market, ultimately pushing toward quantitative easing. Now we present the clips of Peter Schiff's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
I was on this podcast, and even on my appearances, I know I said this when I was on Fox Business and whatever else interviewed me. I said that when the Fed cuts rates, short-term rates, that's going to be the bottom in long-term rates, and they're going to go up. And that's exactly what's happening. Long-term rates and gold prices are rising in tandem. And that is the opposite of what most people think. They think, oh, higher interest rates are bearish for gold, but gold is going up anyway. Now, since the mainstream financial media did not expect this to happen, they thought that when the Fed cut short-term rates, that long-term rates would follow instead of going the opposite direction. The excuse that they are making for what's happening in long rates is they're saying that, well, the economy is not as weak as we thought. And therefore, long-term rates are rising because we just found out that the economy is not as weak as we thought. And so maybe the Fed won't cut rates as much as we thought. And so now the longer end is backing out some of the rate cuts that they had priced in. And that's a bunch of nonsense, because the economy is not stronger than we thought. It's actually weaker than anybody thinks. So we still have a weak economy. That's not why rates are rising. Rates are rising for the same reason the gold price is rising. It's because the Fed's rate cuts are a mistake. The inflation genie is not back in the bottle. We're going to have rising inflation. We're going to have skyrocketing fiscal deficits. So bigger budget deficits. We're going to have more supply of treasuries hitting the market, which, as I've said, are going to be monetized. I said the reason that the Fed is going to go back to quantitative easing, and I've said this since before they cut rates, when I predicted that the rate cuts would result in rising bond yields, I also said that eventually the Fed would end up going back to QE to try to get those bond yields to go down. because I knew that the rate cuts alone wouldn't be enough because they were inflationary and they were bearish for bonds. So if the Fed really wants bonds to go down, it's going to have to buy the bonds itself. But of course, first it has to stop selling bonds because that's what it's doing now. It's selling bonds, and a lot of other people are selling long-term bonds. You'd have to have your head examined to want to buy a long-term U.S. Treasury, even at 4.2%. Inflation is going to be well in excess of that. That's what the gold market is saying loud and clear, except nobody is paying attention, at least, in the mainstream, because inflation is going to be much higher. And that's why the gold price is rising the way it is. And that's why bonds are falling, because inflation is bearish for bonds and bullish for gold. And so they're doing exactly what you would expect that they would do if you understood the predicament that the U.S. economy is in, and if you understand basic economics and finance, which of course nobody does if you're in the mainstream financial media, and most of the mainstream investors don't really understand what's going on. That's why they're not buying gold and silver. That's why gold and silver, even though they're rising steadily, they're not like soaring, right? Because there is no panic to buy. It's a very orderly, methodical rise that's happening day after day after day with minimal corrections. And you're not seeing any, blowout move in the mining stocks. Yes, finally, we have new 52-week highs, multi-year highs in the GDX and the GDXJ. The next key resistance is to really take out the 2020 COVID high. Even though gold itself and now silver, both metals are higher than they were in early 2020. Neither of the gold stock indexes, or there's more than two, but none of the gold stock indexes have taken out their highs yet from early 2020. That's coming up. That may happen this week. And then I think it's off to the races.
During the interview, Peter Schiff predicted that tariffs would incentivize countries to move away from the dollar. He explains that China's support for the dollar hinges on their exports to the U.S. Foreign companies will seek other markets if tariffs make American goods more expensive. Trump has made universal tariffs a core part of his economic pitch to voters, suggesting a 20% tariff on all goods from all countries and a higher 60% rate on Chinese imports. The de-dollarization process, termed impractical a decade ago, is now a reality in 2024. Emerging economies are discussing issuing a common currency as they look to ditch the U.S. dollar for trade. A common currency would be a paradigm shift in how global trade operates. However, Peter argues that Donald Trump's view of trade surpluses is misguided, as these countries provide the U.S. with products without requiring full payment. He asserts that while tariffs reveal America's reliance on imports, simply imposing them won't solve the economy's fundamental issues. Let's get back to the interview.
One of the things that the tariffs are going to do is increase the incentives for the world to ditch the dollar and move away from the dollar. Because one of the main reasons that China, for example, has propped up the dollar is because so many Chinese companies are selling goods to Americans. And if the dollar crashes, well, the Americans can't afford to buy the goods anymore. And so they want to keep the dollar strong so their companies can keep earning strong dollars by selling their goods. And, but I've always thought that was a mistake because it's really just vendor financing. We can't afford to pay for the goods, so you need a better customer. It's not worth preserving customers that you have to loan them the money to buy your stuff indefinitely because they're never going to pay you back. But this has been going on. But if we start hitting tariffs on all these products, making them much more expensive for Americans to buy, Americans won't buy them. And so if it's much harder for Americans to buy foreign products, then how are foreign companies going to earn dollars by selling to Americans? They're not. See, Donald Trump just thinks, well, they'll just eat it, right? If we put a big tariff, the businesses will lose money. They're not in business to lose money. They're in business to make a profit. They're not going to sell to America if the business is losing money. Now, the country as a whole was losing money because they had to buy treasuries and prop up the dollar. but the individual business still earns these dollars that maybe the government taxed all the citizens through extra inflation or whatever to prop up. But when the individual companies start losing money, then it doesn't matter. The American market becomes irrelevant because nobody can afford to buy. And so now the Chinese start looking for other markets to sell their products to. And so why bother to prop up the dollar? And of course, the flip side of the dollar as the reserve is, how do you earn dollars? You export to the United States. You run a trade surplus, and then you earn dollars and you build up your reserves. Well, if you're not building up your reserves because you're not earning dollars because Americans can't afford to buy your stuff, you just move away from the dollar. And, there's more rhetoric, too, out of the Trump camp. They keep looking. Donald Trump looks at all these countries that have trade surpluses with the United States, which is basically everybody. And they'll say, oh, look, even Ireland, right, is taking advantage of us. We've got a huge trade deficit with Ireland at our expense. Like the Irish are ripping us off. They're actually providing us with a subsidy because we're not actually paying for this. He looks at it like he's a businessman. And he's saying, hey, Ireland is a company and they're generating all these sales, right? And they're making a lot of money selling us products, but our companies aren't making money selling them products. But they're not really selling us anything. They're basically giving us these products because we're not really paying for them. We're just printing up money. And so we've been exploiting Ireland and everybody else. Right? Trump doesn't get that. And he also thinks if we just put up these tariffs, okay, great, we're going to make the stuff ourselves. Trump is right. The fact that we have all these imports and that we're so dependent on foreigners is a sign of a fundamentally weak economy, structurally weak economy that needs to be fixed. But just erecting walls isn't going to fix the underlying structural problem.
Over the last year, the precious metals' surprising but impressive bull run has been an added draw. The perfect storm of economic drivers has resulted in the precious metal experiencing a significant price surge in 2024, attracting seasoned investors and those new to the market. Given these dynamics, how do you see gold's role evolving as a hedge while the US dollar faces challenges in the current economic landscape? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos.